Hello and welcome to this fresh new mutual fund YouTube edition. Today we are going to discuss everything about debt funds because there's been an indication that rate cuts could be there. Will it make a good time to look at debt funds and fixed income asset class in general? Let's discuss this with Kalpesh Ashar, who's CFP, RIA, Full Circle Financial Planners and Advisors. Kalpesh, thank you so much for joining us today. And you know, it's a tricky asset class to understand, and that's why we definitely need experts like yourself to explain that to us. Considering the macros that we are in and the indication that we've been getting around rates, do you think debt is a good asset class to look right now from the mutual fund investing perspective? How do you look at it?
Thanks for having me here, Sonal, and Happy New Year to you. Like what you rightly said, you know, that debt always, I would say, has been a distant cousin of equity in terms of people looking at it from the mutual fund point of view. And, you know, I don't know whether to call it fortunate or unfortunate. People still relate mutual funds only with equity.
Yeah.
And debt, like you said, I think the right word is tricky because there's so many facets to it and it's a complicated thing to look at that people actually tend to ignore it.
Correct.
So that is the hard fact about debt. But I think in a core financial portfolio, the importance of debt funds for a retail investor, I'm not talking about the corporates and the institutions which constitute a very big part of the debt industry, which is there, that AUM which is there. So talking of the retail people, I think it is a very integral part of individual's financial portfolio. It offers diversification. It offers even yet, we'll cover that later on, I think some tax advantages, I would say. And also it is a pure, I think, instrument which helps you achieve your financial goals. So there are many, many aspects to it. Now coming to the core question, how people should look at it right now. People who understand debt and the fixed income, scenario which is there, we've been living in a high interest rate regime for the last 2 years or something, or 3 years, and we've been stagnant at that, and there's been no, I think, clue that we would come out of it. Of late, I think last 2 months or 3 months, there have been signals first by the US Fed or the central banks that we could see a rate reduction in this 2024. Now, if that happens, I think the first thing which will happen is it will be advantageous for the medium to long-term duration debt funds, which are there. And as it is, you know, in technically speaking, there's an inverse relationship between the interest rates and the bonds. So now if the interest rates are going to come down, the bond yields would rise. So that could happen. And it will be advantageous in that category of people who are perched there. But I would not like to take a call on debt so easily because debt could swing either way. And if that does not happen, the presently favorable, short-term or the ultra-short duration funds which are there, which are giving good, type of returns, I would still like to keep at least 50% of my, funds which I advise, obviously, in that category. Because a what-if scenario is very much pertinent. The clouds have still not gone over the geopolitical space or anything on that. And I think as an advisor, it would be prudent that in debt, which I personally look at as a category to be in the safe zone, not look at taking extra risk there and easy liquidity. I think I'll be 50-50 into both the categories.
Okay, so and you know, we are in a world where anytime anything can happen.
Absolutely.
So you'll never know how things would go. Macros also in terms of the Red Sea issues, and a lot is happening. So you never know. But as we were pointing out earlier, equity has always been the favorite. Fixed income is a place where people do not understand a lot. So tell us some of the key points that if a retail investor is looking at the fixed income place, they should keep in mind while looking at investing here.
Yeah, absolutely. So 3 to 4 pertinent points, I think, which everybody should look at. So when you put your money into a debt fund or the fixed income space, what is more important is the quality. So that is then denoted by the credit ratings. So in debt space, like I said, that I'm an advocate of not taking higher risk. I would always be looking at the highest credit rating of a particular scheme or a portfolio and take my investment there. So if you understand credit ratings, AAA is the highest rating which we have, but the interest rate there is a little bit lesser. And the AA category, which is the second best, the interest rates are a little bit higher there, but it can be looked at. So even SEBI, in the categorization which they did, so they've said that, in certain funds you could look at 80% AAA and 20% AA. Because anything then below that, in terms of B or B minus or all those things, then go into a credit risk category. And then there's always, you're prone to these external accidents which happen, in which a normal investor would be really, I would say, scarred in a debt space. He would not expect to get scarred there. Equity, yes, he knows there's volatility, there's going to be, up and down, and there's going to be accidents. But debt, he comes with a mindset that he would probably equate it somewhat to a bank FD, though it is not. So we don't want accidents to happen. So credit rating, prime importance. Second is the duration in which you are investing. So if you know that in higher the duration, you have higher the risk, because there's a lot of events which would play out in between there. So the element of risk would always persist. And lower the duration, lower the risk. So you should decide according to which goal you're intending to invest, how much time would you like to spend in a certain debt fund, and take your call in it. So all the bonds come with, now everything is transparent, you know the portfolio content, you know what is the duration, average maturity. All these are technical terms for mutual funds, but it needs to be seen because duration plays an important part. And third thing I think is important is that we should be understanding that this entire platform of debt funds is based on the interest rates. And I think we should be a little bit spending more time in getting ourselves financially educated as to whatever our profession is. In which interest rate regime are we? Are we in the high interest rate regime? Are we in the low interest rate regime of our economy and all those things? Because the entire movement of bonds and everything is dependent on the interest rates, because that determines the volatility in a debt fund. Unlike an FD, which is very, very straight and simple.
It's a fixed thing.
It's a fixed thing and it's not traded, whereas a bond is a traded item. So we should understand that. And again, like I said, I can't, lesser stress the importance of the quality of the portfolio. Because you just can't invest in any trash and expect that in debt you would get an alpha there.
Of course.
Because for that, generating that alpha, asset allocation is necessary, and the best asset is equity. So, have a proper prudent mindset when investing in debt. And I think it's a brilliant asset class to invest for various purposes.
Okay, so we'll discuss that as well.
Yep.
But basis the different tenures that you mentioned, longer duration would be volatile. But what are some of the, debt funds based on tenure where one can invest?
Yeah, so it's actually a textbook classification, but I would surely like to mention it because people need to understand. So as I said, debt gives you a complete option of investment according to your investment time horizon. So even if you want to, like the corporates or someone would like to invest for something like a day or two, you have the overnight funds. Okay, you can park your money for a day or two as well.
Yeah.
Obviously with all the caveats which are mentioned there. Right up to 1 day to say 3 months, you have overnight funds, you have liquid funds and money market funds. Then if your investment horizon is say 3 months to say 1 year, then you have the ultra short duration funds, the low duration funds. Again, I'm not stressing because I've already stressed that you should see what quality of paper is being held in that.
Of course.
After that comes the 1 to 3 year period where you then tread into the short term and the corporate bond funds which are available out there. I'm talking basic ones.
Yeah.
Because as it is, there are a lot of flavors then given by fund houses. You have a dynamic bond fund category and you have a credit risk. I'm not getting into that right now. So you have the short term and the corporate bonds where people can take a call for 1 to 3 years. 3 years to 5 years, you have the medium term bond funds. Now the medium term bond funds, again, the duration is matched to that. In between, we had this, season of target maturity funds which came up. And I think those were brilliant instruments because you knew that if you stayed the course, you would get that fixed interest rate, what is desired. And those were all investing in government securities.
Correct.
So that was the best thing to do in that time zone. And obviously beyond 5 years, then you get into the gilts, which is the government securities. Again, there is no compromise on quality because it's government sovereign guarantee which is given there. So that is 5 to 10 years. But then again, that is completely, engulfed with volatility. Because what happens in the interest rates like what we are experiencing right now, the entire burden of that is taken on the long side of the bonds.
No, that makes sense. And thanks to you to mention it in different categories, because sometimes all of it becomes very overwhelming for an investor because there's so many subcategories to this, right? But in that case, what do you think would the ideal split be between somebody who's a high-risk investor, who is a conservative investor? How should they look at debt and equity in their portfolio?
So, without getting into a further detail of stage of life, if you just want to classify yourself, because that is a very important thing, that which stage of life are you, what are the financial goals you're looking at. Those are very, very important decisions when you do an asset allocation. But here we are talking about, if you're asking the mindset, which is aggressive or medium or conservative. If you're an aggressive investor, obviously you could be looking at anything between 70 to 30%, that's 70% in equity and 30% in debt. If you're conservative, or I would say moderate investor, then it's a no-brainer, 50% to equity, 50% to debt. And if you're really conservative and you want to create a portfolio, then the other way around, debt is 70% and equity is 30%. So that would make a prudent mix. But again, everything depends on person to person.
Of course.
His behavior and his financial goals.
Totally. And that's why they come to advisors, right? Because that is where they understand everything. Last question before I let you go. There's a lot of interest mostly from corporates and institutions and not so much from retail investors and fixed income asset class. Why is that?
So again, quite an unfortunate thing, because people still relate mutual funds with only equity. And we've always seen that the AUM earlier, that the debt AUM was always large, but that was still constituted by corporates and retails taking it because they used to park overnight money or park money for a short term, alternate to current account where they get nothing. But I would blame it on, I think, lack of awareness in the retail investor. And he's really not aware that even you can put your money into debt funds. And even whatever that one benefit which was there on taxation earlier in the debt category was taken away in the last budget, placing it on par with FDs. The short-term capital or long-term capital was not there. So the point here is that that element was taken away. But here I would like to draw the attention, Sonal, here is that yet there is a distinct difference between an FD taxation and a debt fund taxation, simply because on FDs, the interest which you earn, you get taxed on accrued basis.
Correct.
Whereas in debt funds, whatever is the gains you have, you are not taxed till you redeem. So people should not forget that they're saving that much tax every year on something which is similar in terms of returns.
Okay, that makes sense, because there was a lot of hue and cry when the tax was imposed,
Absolutely,
that it is at par with FDs, but nobody realized till then it's notional. You've not really received it. It comes in later. But Kalpesh, it was a pleasure speaking with you. Thank you so much for explaining this very tricky, as I said, asset class. Thanks for making it simpler, and hoping to speak to you very soon.
Thanks, always.
Okay, all right. With that, we'll take your leave on this edition of Mutual Fund YouTube Corner, but stay tuned for more news and updates.